Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest, and he's actually one of my favorite guests. He's been a gold fund manager, gold stock fund manager, and a Bitcoin manager for years now. He's also an Austrian school economist. Lawrence Lepard, thank you for joining me again.
Hey, great to be with you, Jason. I always enjoy our conversations. I'm surprised I'm one of your favorites. I don't bring good news, right?
Well, I think you're one of the only people out there that's actually kind of balanced on gold and Bitcoin. I mean, it's so polarizing nowadays. It's like I was
Yeah.
looking at my Twitter an hour ago or before we started recording an hour ago, and we're recording this interview on Monday, February 19th, 2024. And it's just so polarizing. I mean, I think there's room in people's portfolios for both. There's a lot of discounts. We'll talk about this later in the interview across the board on gold stocks, oil stocks. The commodities are just hated right now.
They sure are. Yeah, it's a tough climate. I mean, we still, as we were talking about pre-show, we still live in a bubble. I mean, if somebody had told me a year ago that we were going to go back and revisit and exceed the all-time S&P 500 highs that we achieved in January of 2022, I'd have said there's just no way. There's absolutely no way.
Well,
and yet here we are.
Let's talk about those macro factors. And so, I mean, I think the average person, they see the headlines that the Fed is reducing its balance sheet with quantitative tightening, but that's just on one hand. I mean, it's a shell game. On the other hand, there's all those emergency liquidity programs that the Fed has that the banks have access to. I know BTFP is supposedly ending in March, but normally these government programs, the name has changed. They create a new one every time there's a panic. There's also like FHLB. There's the repo programs the banks can borrow from. And then I think the new macro theme now, Lawrence, is that there's a lot of flight capital because the global economy, whether it's the European Union, Japan, United Kingdom, China, there's a lot of flight capital leaving those countries, and it looks like it's coming to the United States and also into Bitcoin.
Yeah, I think that's right. I mean, the one that you mentioned that I think a lot of people missed. I think it's an important thing to understand. The BTFP, I think it started off at like 80, 90 billion, which is a lot of money, and it's up to 140 now, I think. And they do say they're going to unwind it, although query how quickly it'll happen. I think it's going to take some time for them to unwind it. But the one that really blew my mind, it was hidden, was when Silicon Valley Bank went down in March of that year. When it went down, I thought to myself, okay, this really is it. They're not going to be able to contain this. Of course, they did. And you know how they did it is they put it all on the FHLB balance sheet. I mean, there was like $1 trillion. Well, they also used the repo window too. So the repo window blew out, and the FHLB guys loaned another $1 trillion into the economy and into the system. And I mean, this is what they do. They create new forms of liquidity, and they basically, these are all just different forms of what we refer to as burr. Money printer goes burr. And I mean, some money dies, money goes to money heaven, in the sense that, Silicon Valley had negative equity because they had, very cheap long-term bonds that, once marked to market. I mean, what we're talking about that, one of the points I want to make that I thought was fascinating, and I don't think enough people have focused on it, was how quickly Silicon Valley Bank went public and how quickly things can change. And the point I mean, you kind of think of, the Bailey Savings and Loan in It's a Wonderful Life. And all the guys running down the corner, and they all want their money back, and of course word spread quickly through town. But here we had a case where what happened is out in the Silicon Valley area, somebody noticed that the bank, Silicon Valley Bank, was forced to sell some bonds because they needed some liquidity, and they took a huge haircut on that sale, and somehow that got reported, and the word kind of spread. Go ahead.
Did you see it's the Fed? It was the Fed that did it. The Fed did a PowerPoint presentation. It was on a webinar, and they actually cited Silicon Valley Bank on there for duration risk. So supposedly Blockworks Macro YouTube channel talked about this, and they had experts talking about this. Supposedly the Fed never talks about specific banks, and Silicon Valley Bank was specifically targeted for having duration bond risk. And so the short sellers, they saw the presentation, it got around the community, and then they started, and then all the tech investors that had their money there. So like a Peter Thiel and David Sachs and some of those other guys, the word spread so quickly. And that's how you had the digital bank run in less than a week.
Exactly. That was the point I was going to make. I mean, there was a day, I think they had roughly $100 billion of deposits. They had a one-day withdrawal of $45 billion. Almost 45% of the deposits, with a mouse click, went bye-bye in a day. And of course, 2 days later, they were bankrupt. And I mean, so the reason I think this is interesting is that, what happens when we have a similar situation in the U.S. Treasury market, right? I mean, and I'm not suggesting we will, and I'm not suggesting we're at that point yet. But the point the point I'm trying to make is that everything is so interconnected. Word spreads so fast. There's all kinds of social media. We've got the internet, and everybody's got the ability to pick up that mouse and click that button. And so, you could see, we could see some really, really wild moves in a lot of different areas. Now, I think the Fed, I think the Fed has the intention and the ability to control what we consider to be the normal markets, because we all know the tracks are there that as an example, they're not going to let the S&P 500 crater 10, 15, 20%. They've got circuit breakers, and they've got the ability to get in there and just buy the futures. But where they can't hide it, there are markets they can't control. And specifically, I'm thinking of the two sound money markets. I'm thinking of the gold market. I'm thinking of the Bitcoin market. And there's just no way. I mean, they do kind of control the gold market. We all know that, but they really can't control the Bitcoin market. What happens when if they have a God candle where Bitcoin is up $30,000 in a day? I mean, I'm not suggesting that's going to happen, but I'm not saying it's outside the realm of possibility. If contagion occurs, it could get real interesting in terms of how quickly things could happen.
Well, it seems right now the Fed's kind of getting away with keeping interest rates where they are. We haven't had bank failures yet. We haven't had problems with treasury demands yet. But I mean, there's a lot of looming problems with how much debt needs to be sold and refinanced at higher and higher rates. I think 10 trillion of debt has to be reissued or refinanced in the next 12 months. It's at much higher rates. The interest payments on the national debt are absolutely astounding. I think it's one of the highest one or two line items now. We could go on and on. I mean, I think we're adding $1 trillion of debt now in every 100 days.
We certainly did in the last cycle. And I'm not sure it'll stay there, but yeah, it appears to me the deficit's running somewhere around $2 trillion a year. The national debt is $34 trillion. The interest cost on that debt is about $1 trillion and growing. And because the average on that debt is somewhere right around 3%. And yet the average across the whole bond curve is much higher, not much higher, but it's higher than that. So, I mean, look, we are in a sovereign debt crisis, and we have a serious fiscal problem. And I don't see any will on the part of government to address it in a responsible manner. I mean, you don't see anyone talking about tax increases. You don't see anyone talking about spending cuts. In fact, quite the opposite. They kicked the can on the debt limit, and so we're not really going to address that until after this next election. And in an election year, the odds of the government cutting spending, I would suggest, are extremely, extremely low. And in fact, I had this in my most recent quarterly report, which people can go to my website and see, and there's a great chart. But it was very instructive to me that if you look at historically here, the government pre-COVID was spending about $4 trillion a year. And it was kind of growing consistently, but it was a $4 trillion number. COVID hit, bam, it went to 6 and then 7. Okay, now COVID's now over, and the economy is now running again. And theoretically, it's healthy. They say it is. I disagree, but and we've fallen back to 6.2. So we kind of reset government spending. The government is really crowding out the natural economy, and this is why I was wrong about the stock market, because the fiscal spending has just kind of kept everything going. I mean, in a normal cycle, that spending wouldn't have been jammed. I mean, Biden has more or less had his foot on the accelerator. Biden and Yellen have had their feet on the accelerator. They're just jamming it.
Well,
and we've got the infrastructure bill. We're just spending everywhere, and that's what's keeping the economy going.
Well, they're also counting that government spending positively. It's not being subtracted from GDP. I mean, I would argue the return on investment for a lot of these green energy projects, wind, solar, biofuels, it's zero or it's negative, especially if these companies are going bankrupt.
Well, that's right. And it's not just there, but some of it's transfer payments, some of it's student loan forgiveness. I mean, it's there are a lot of things that the government does which just don't make any sense. I mean, and some of the employment growth, there's been very strong employment growth in the government sector, right? Well, how much value added are government employees versus people who actually work at providing services or goods, right? I mean, government doesn't do either. It's administrative. So yeah, it's an unmitigated mess and / disaster. and we can all see it, and it's kind of hard to watch because it's like a train wreck. We can see it coming.
Well, we have
But
we have warnings, right? So there's warnings out there. I know the stock market doesn't reflect this, and the GDP, the jobs numbers, the inflation data doesn't really reflect this. But we have warnings from three bank CEOs. Jamie Dimon has issued warnings about the national debt. He sold, I think, JP Morgan shares for the first time, I think, in his career. We have warnings from the Bank of America CEO that the full effect of the interest rate hikes are not priced into anything. And then the CEO of Cantor Fitzgerald Bank, one of the reasonably sized investment banks, he's saying commercial real estate is going to be the main crisis window coming up in the next year or two.
I think that's right. I think the CRE, and we were talking about this pre the show, I think the CRE really is going to be the center of the next one. And as you mentioned, I guess you are in DC, I know, and you're very well connected. And you said that what you're hearing are rumblings that they're putting together some kind of a Fannie Mae like or Resolution Trust Company like, facility to help the CRE, the CRE market. And, it's to me, it's pretty stunning. I mean, we know, that the banks have at least 600 billion of negative equity on their books, and arguably, I think Barry Sternlicht said it was closer to 1.2 trillion of the losses in their CRE holdings. And the interesting thing though is these CRE holdings are spread all over the place. I mean, they're kind of, they're in pension funds, they're in insurance companies, they're in banks, regional banks, and there will be more regional banks that will fail, but they take time to surface because some of these loans don't roll immediately. So it's not going to look like the '08 crisis where it kind of happened all at once and you had these incredibly leveraged investment banks, but it is going to happen because
they didn't have
the
2008. So let's
Yeah,
talk
go ahead.
about 2008. They didn't have those liquidity programs in place. They had to start putting them in. They panicked and started putting in the alphabet soup. Same thing what in 2020. They have a lot of those liquidity programs in place. They can start issuing the bailout programs, emergency liquidity programs. They already have those programs in place. They can either restart them or create new ones much quicker than in 2008.
Correct, and they will. But again, with that, all we know with high probability is that money printer go burr, right? Because they can't let this system implode, and they've made it very clear that they will not let this system implode. And I think you saw a really excellent case. Again, we talked about this in our quarterly report as well, where the Fed really blinked in Q4 of last year. In October, when I mean, it kind of felt to me like what happened with the gilt crisis over in the UK. Um, when the 10-year went to 5% rapidly, in kind of September, October last year, you saw all these Fed guys come out and say, "Oh no, the rate hike cycle's over. Next thing is going to be a cut." They basically jawboned the market down because the market cannot handle, the U.S. economy cannot handle 5% 10-year and 5% short interest rates. It just can't. I mean, look at the math on the debt for the federal government. Creates just too large a deficit, and so they know they need to lower rates. But it puts Powell in a very, very difficult position because he wants to be Volcker, but he can't be. I mean, if he is Volcker, he's going to crash the economy, and if he's not Volcker, he's going to ignite the next. It's going to be Arthur Burns, and we're going to have another round of inflation. So, I don't. And to be honest with you, I've given up trying to guess what he's going to do. I just don't know. I think, I mean, my gut, just my inside gut tells me that even though this last inflation report wasn't that good, I think they're going to get some relief from the owner equivalent rent on inflation. And I think we're going to get a couple of decent inflation prints, and that's going to give them an opportunity to cut rates. It's very clear to me they want to cut rates. And I say that because I'm looking at Nick Timieros, who's the Fed whisperer for the Wall Street Journal, and they kind of signal where they're going by letting him know what's going on. And his indication is, oh no, even though these inflation numbers haven't been quite what they wanted, they generally speaking think they're on the right path and that rate cuts are coming. And actually, if you look at the Fed Watch tool, you can see that the market's now saying we'll probably have a rate cut, one or two rate cuts before June. I mean, it's not a certainty, but it's a reasonably high probability. And I think they have to cut rates, Jason, because if they don't, the interest costs are going to eat everybody alive. And of course, once they start cutting rates without inflation really being down, what you're going to ultimately see is everybody's going to realize that, I mean, the biggest thing I think is going on kind of big picture. Okay. Big picture is we are no longer in a deflationary world. I mean, we are with respect to some things, technology is very deflationary, but we had an unusual combination of a lot of events that for 40 years drove really, a really good deflationary trend. And In my opinion, those things ended in March of 2020. And since that point in time, we now live in an inflationary world where commodities are going to be expensive and inflation is going to be a persistent problem. It's going to look much more like the 1970s. I know a lot of people, I mean, Econ Guy Rosie and a lot of traditionalists think I'm full of shit and that there's no way
Well, I
that's
think
what's
it's more
going on.
I think it's
Yeah,
more distorted because of policies here out of DC with the federal government, all the different policies, and then policies from the Federal Reserve Bank. I think the distortions, they've created a clear bifurcation in the real economy. With the policies where the Fed is doing, well, they're not reducing the balance sheet enormously right now, but they did do quantitative tightening and reduce the official balance sheet by over $1 trillion. They kept interest rates here, and we haven't had the amount of pain yet, but now we're starting to see those layoffs for a lot of these companies
correct,
with interest rates.
correct.
It's consumer. So these distortions, for example, I would say that the real economy is bifurcated. So if you don't have a lot of high interest debt, you locked in your mortgage, you have a high paying job over $250,000 a year, you're not dealing with the same types of problems that someone is that has a much lower paying job and has high interest debt on credit cards, student loan debt, auto loan payments, all those things. We're seeing this in the consumer discretionary companies with the credit card debt and the interest rates where they are. So the discretionary, that's part of the distortions and the bifurcated real economy, in my opinion.
And I completely agree. I mean, there is a small part of the country that thinks everything's fine, and those are the super upper middle class where, yeah, they have a long dated mortgage at 3%, and their job's not a threat, and they have decent income, etc. But even they are facing increases in everything they do. I mean, their insurance costs have gone up. I mean, you name it. It's we all see it. And we all know that even though they claim inflation has come down, it has for sure, but it hasn't come down as much as they say it has. We also know the inflation numbers have always been, inaccurate. I mean, they cook them to a certain degree. I mean, I'm in Florida as an example, and I'm hearing about stories of people's, housing. I mean, my housing insurance went up, I don't know, 15-20% last year, and I'm a lucky one. People who are I'm in Naples, and so there was a hurricane that came through here last year. Well, all the people who were in the hurricane zone obviously had large losses and claims, and they all have their insurance going up 100 to 150%. Now, that's not something that applies nationwide. But my point is that, I just saw some statistics that show that automobile insurance has gone up consistently, well above the inflation rate, and so almost everybody pays for automobile insurance. So, it's yeah, it's a real problem, and the inflation is very persistent. I mean, you know, um, and the reason, I think one of the reasons it's persistent is a lot of it's in the labor department, in the labor category, and it has to be because labor. I mean, if you work and you've seen I mean, everybody's costs have gone up at least 20% since COVID, at least. And so if you haven't gotten a 20% raise, since COVID in the last 3 years, you're behind, significantly behind. And I would argue that it's even worse than 20%. And so,
Especially for food.
so
Yeah.
yeah, exactly. And so you're seeing, people who are screaming and saying, we need more money, and all the way across the board. I mean, every category, and where there's a shortage or where there's real pricing power, like the airline pilots. I mean, we don't have enough pilots. These guys are getting 15, 20, 30% bumps, on their salary, and so it's there. It's definitely there, and history shows the '70s show, and it was different then. It was oil, and I know it wasn't the same economy as this today. A lot of things are different, but one thing that is a common thread is that once inflation gets going, it is very hard to contain.
Yep. And it
Without
comes in waves.
absolute,
The
yeah,
40s.
exactly, without draconian policies, it's very, very hard to contain.
Our mutual, our
Without,
mutual
yeah, go ahead.
I was going to say our mutual friend Tavi Costa has put out some excellent charts on his Twitter
Exactly.
at
Yeah.
Prescott showing how inflation came in waves in the 1940s and the 1970s. So it didn't go straight up. It took breaks. The central bankers thought they had it under control. They took the foot off the gas pedal. I mean, the economy, like Lawrence said, it can handle high rates. I mean, we're going to start to see a lot of pain, I think, in commercial real estate, regional banks very, very soon. We're seeing like they're not calling it a default, even though like the insurance companies are selling some of these office buildings for 80-90% discounts to what they were appraised at only a few years ago. They're not, it's like, oh, it's not a default, wink, wink, nod, nod, same extended pretend games from 2005, 2006, 2007, except last cycle was residential real estate. This cycle is office buildings and multifamily.
Yeah, that's exactly right. And Yeah, so it's going to be a problem. And as I was saying earlier, I think the deviant perception that a lot of people are missing is that this inflation is persistent, and so the sucker at the table is the bond market, and interest rates are going to have to go higher in order to provide real rates of return, or else people are not going to buy bonds. And as those interest rates go higher, that creates what we all call kind of the death doom loop, as because the cost of interest. I mean, the government is the largest borrower in the world, and as their interest costs go higher, their deficits go higher, and so and more deficits, and they got to borrow more, and all ceteris paribus, all things being equal, they got to borrow more. There's more demand against a limited sized bond market, and interest rate go even higher still. So,
Wait,
you
so
know,
you don't think that there will be rate cuts? Are you saying that mathematically they shouldn't cut rates, or that there won't be rate cuts?
I don't honestly know what they will do and won't do. I've really kind of given up trying to predict it because they're a bunch of jokers. But and in terms of what I think they should do, I actually think that I'm with Luke Groman on this. I think the only way out of this is actually to run the economy hot and to have inflation, and enough inflation that we actually get back to a stage where the real economy is large enough relative to the size of the deficits and the debt. But I don't, whether they will do that or not, or how they will go about trying to attain that, I really don't honestly know. I'm not smart enough to know, and nobody is. It's impossible to tell. But I think in a democracy where we just proven that we know how to send out money to people, we know how to print money in many different imaginable ways. I think the strong tendency is going to be, to try to monetize and print and keep things running. And, I mean, look, the two alternatives are very clearly, okay, fine. We really do a legitimate Paul Volcker. We raise interest rates to the point where we have a really positive real rate. The rate on debt is well above the rate of inflation. And by the way, we would take one hell of a recession. There'd be massive layoffs, a big downturn, lots of bankruptcies, a real economic shit show. But the dollar would stabilize, and we would create some responsibility in finance. But I think the odds of us doing that, because of the pain that would cause, are relatively low.
Yeah, I
And then
agree.
when push comes to shove, the policymakers are going to prefer to try and keep everybody working, and try and keep the economy running, and try and keep the economy growing. And of course, the price of that will be that there'll be inflation, serious inflation, consistently.
Well,
And arguably kind of South American style inflation, like, not 5%, but like 10% or 15 or 20%. I mean, Israel had a bout of this kind of stuff in the 80s, and they had huge debt to GDP, and they ran really hot inflation for a bunch of years. Then they got it under control, and everything returned to normal. And that's Groman's thesis. That's what we should do, and that we could do that. We could reshore a lot of our industry, and if we printed money and spent it on the right stuff, that arguably would be a good industrial policy to use to counter China, and what they've done. Now, I can take both sides of that argument. It's not clear to me that that's the right way to go. I mean, look, at the end of the day, I think that we are going to have a lot of inflation. Ultimately, I think we're gonna lose control of it, and we're gonna have hyperinflation. And I don't enjoy predicting that. And when I say that, a lot of people come back and say, you're a doomster, and I'm really not. I'm much more of a. I've studied how economics works. I've studied how economies work. I've studied economic history, and I've looked at countries that have done what we've done and behaved the way we've behaved. And once you get on this debt spiral, that we're on, it's extremely hard to step off it. And the end point is usually, I mean, countries who've done. I mean, this is the first time a world reserve currency country has done it. Okay, but in general, what we are doing, monetizing deficits, growing our debt, spending beyond our means, all of that, this has been done before by many other countries, and the end result is always the same. Their currencies decrease in value to the point of worthlessness, or to the point of very high inflation, and they have to either do a currency reset, or their currency totally fails. I mean, it's not like what we're doing is unique. I mean, it's been done before. Hasn't been done at a reserve currency level. I'll admit that. And that's why it's going to take longer and there are going to be more waves and it's going to be bumpier. I mean, my prediction time wise for this, what I call extremely high inflation slash hyperinflation, is kind of 2030 ish, and that's 6 years away. And, but you can kind of, Jason, you can kind of see the waves, right? I mean,
Hmm.
2000 was a bubble, it burst, we printed. 2008 was another bubble, it burst, we printed. 2020 was another bubble, it burst, we printed. And, and with each one, the print amount gets larger and these things are starting to get closer and closer together. And so, in my opinion, hyperinflations occur when everyone loses confidence in the currency. And so, right now, most people still, I mean, everyone knows inflation's a problem, but to be honest, a lot of people are kind of thinking, well, the Fed has it under control. We're going to get it back down to 2% and it's going to be okay. I mean, I think the next big shock coming for the market, coming for the world is, the dollar falls pretty hard. That makes the cost of oil in dollar terms go up. Oil is a big driver of inflation in the United States. And the United States in the next few years starts, the inflation starts going back up. And Powell has failed to control inflation. And I don't know what he'll do. I mean, he might be out of office by the time that occurs. He might resign. I'm not sure. But the point is that when that comes, people are going to go, oh, I get it. I've seen this movie. And maybe at that time, the government will do yield curve control, or maybe they'll stop the runoff on their balance sheet, or maybe they'll provide some of the liquidity facilities. I mean, they're going to do a lot of different things. They'll create programs to try and make everybody think, quote unquote, that it's okay and they've got it all under control. But you can be sure that those programs will be inflationary programs. And so,
I agree.
with
I
each
don't think they
way,
can allow
with
deflation for a
they
long period of
can't.
time.
And so with each wave of inflation, more people will become aware of this problem. I mean, pre 2020, or pre 2022, when the inflation really 21, when the inflation really broke out, inflation hadn't been a problem for 20 years. I mean, really almost 40 years, arguably. So as a result, this was the first wave, and a lot of people are now thinking, and mainstream economists are saying, "Don't worry, we're going back. This was a blip. It was all driven by COVID. We're going to be okay."
The economists
Powell's
never
got,
talk. Let me bring this up
yeah,
because I know we were discussing this beforehand about the banking system, fractional reserve banking, and the advantages that JP Morgan has versus, say, a regional bank or a credit
yeah,
union. So I think a lot of those people that are saying like, oh, the Fed has it under control, they don't understand all the problems in the banking system now, how fractional reserve banking, all the loans that the banks created out of thin air. There was an artificial boom when the regional banks got all those stimmy checks, right? They created
yep,
all those
right,
extra reserves, and they either loaned it or bought treasuries, and now a lot of their loan book and those treasuries have enormous losses on them.
correct. I mean, when you create money, it's very easy to misallocate it, and then that's the classic definition, of Austrian definition of malinvestment. And malinvestments get liquidated, and then that liquidation shrinks the money supply, which would be deflationary in all other things being equal. And of course, how does the government respond to deflation? They got to print even more.
Bailouts.
Yeah, we're going to bail them out, right? And so, I mean, as just in the same way that J.P. Morgan was giving enormous gifts, probably under the table and quietly, in order to induce them to buy First Republic Bank, because I mean, look, Silicon Valley and First Republic were smoking holes in the ground. They had negative equity. Okay, I mean, they went out to auction those things, and there were no bids. And the reason there were no bids was no bank was stupid enough to buy a bank that they knew had an embedded loss. But what the government can do, and I think did, and it's not fully disclosed in my opinion, but some of it was disclosed if you dig, was they gave them sweetheart deals. They gave them all kinds of incentives. They gave them certain loans on certain terms, et cetera, et cetera. And so, that's what I believe will continue to happen, is that we'll continue to consolidate into these big mega banks. And this is what happens in a crony capitalist system. If you're on the inside, if the Fed views you as being systematically important, to keeping the system running, they will give you sweetheart deals. I mean, you probably saw recently the Fed is talking about letting hedge funds become broker dealers and having access to the Fed window. Well, gee, isn't that nice?
Is
Isn't
that for
that
like Ken
convenient?
Griffin? Is that for like Citadel, Ken
Well, that's
Griffin?
that's exactly where I was going. I mean, he already has one of those things. Why? Because Ben Bernanke is one of his advisors. The rumor is Bernanke gets $20 million a year from Griffin. And by the way, it was 20 million well spent because when March of 2020 came around and the basis trade blew up, Griffin's firm would have gone tits up, but he could call the Fed and he could get a swap line to give him the liquidity necessary so he could ride that whole thing out. And it was fascinating because I was at Harvard Business School seminar, and his ex-wife was there and got into a big argument with a friend of mine, a guy named Paul Finnegan, and they were talking about, Finnegan said, "Look, you gotta, you should shut your mouth because." Ken would have been bankrupt if the Fed hadn't bailed him out. You should have seen his ex-wife go nuts. I mean, it was
Well,
really quite funny.
did you
So,
see the Dumb Money
um,
movie with Ken
oh
Griffin in
yeah,
there?
yeah, yeah. I loved it. That was a great movie. It was a great movie. But the difference there again is once again they changed the rules, and let's tie that into Bitcoin, okay? Because they changed the rules on the Hunt brothers. They changed the rules on the big nickel trader who had them cornered, in that area. They changed the rules on me. I was short U.S. financial stocks in September 2008, and they banned it, and I lost 4,000 basis points in a week. I should have had a profitable. I should have had a fabulously profitable year, and I ended up being down 6% that year because they took away all my profits by changing the rules in the middle of the game. This is what they do. I mean, the people who are on the inside who have control of the game. I mean, they unwound Glass-Steagall, so that Sandy Will, Citicorp could buy. I can't remember the firm they're trying to buy at the time, but
Well, the derivatives
they
market also exploded too. I mean, like back then, around 1998, there was only around 29 trillion of derivatives when Greenspan and Larry Summers, Robert Rubin, Brooks Lee Bourne. I looked
right.
up the numbers. Only 29 trillion of derivatives. It went up over 30x in about a decade.
Correct. And so the point is, and this is why to so many of us Bitcoin is appealing, because here's a monetary system that they can't screw with. Do you know what I mean? They just can't screw with it. Now, I know some people come and say, "Well, they're going to make it illegal." Okay, fine. But as my friend Chris Iron says, it's a slippery fish. They're going to have a really hard time. Even if they start legislating against it. This is not America in 1933 when you can do a 6102 and count on it working. So, this is a monetary system that cannot be controlled or manipulated for the favor of the insiders, the investment bankers, the government, the J.P. Morgans, etc. It's a neutral, distributed, rules-based, fair, mathematical monetary system, and that is a really, really powerful thing. And that's why it's so threatening to the people who are involved in the old system, because they recognize that if everybody embraces this new system, their system dies. It just completely dies, and that's what I think will happen. But these are big issues and big changes. And I mean, you look at Rome. I mean, probably the closest example we have to a quote unquote reserve currency collapsing historically was Rome. The Roman Empire, and the denarius, which was originally 100% silver, and at the end it was 0% silver, and it was probably close to the being the reserve currency of the time, at least certainly in that area of the world. Not in China and the Far East, but the point is that it took a long time for Rome to collapse. I mean, from the Republic to the end was quite some time, and so hundreds of years, and so
Same for British Empire too.
United,
Yeah.
yeah, I mean exactly, and so and by the way, the pound has not really collapsed. It never became quote unquote worthless. It's been massively devalued from where it originally was. The pound is the oldest surviving currency in the world. And so in any case, I mean, the point is that this is what I'm describing could end up, I think it could happen by the early 30s. And I'm kind of using fourth turning theory to get to that kind of a time frame. But there are many people who say it's going to take much longer than that. It very well could. I mean, we have to remember that the people who run the system have all the money and control all of the, they're holding all of the levers, and we don't have those levers now. And one of the levers they held that was very powerful is they used to completely dominate and control the press, and the messaging. And, thankfully the internet and, Joe Rogan and Tucker Carlson and others are kind of, we've eroded that significantly so that, nobody really takes what the New York Times says with any seriousness anymore. But the point is that, it's going to take time for the change that I'm talking about to occur. But I sure wouldn't want to bet against the trend because, we're in it right now. I mean, Bitcoin was up 150% last year. I mean, this year, I don't know, what are we, a few months in, it's doing very well. So,
Do you think a lot of that is because of currency debasement that's not in the US dollar? So let's say like Argentinian peso, Turkish lira, Chinese yuan, that people in those countries on a relative basis, their currency is being devalued way faster than the US dollar is. And so if you're in one of those countries, Bitcoin is very appealing.
Absolutely, absolutely. I mean, look, there's currency debasement everywhere, and obviously Turkey and Argentina and well, before them Venezuela and others were much worse. It's interesting though. I mean, take Turkey as an example. I've talked to people who've been there, and they said, there are Bitcoin buyers there. Don't get me wrong, but the average Turk who's trying to protect, against his Turkish lira, becoming less valuable every year, they're doing one of two things. They're either buying gold, which obviously makes sense, or they're buying the U.S. dollar, which is depreciating, but not as quickly as their lira. So, it's Brent's point. The dollar still is the cleanest dirty shirt, and as a currency, as a transaction currency, it's probably the most liquid currency in the world. So,
But
the
Bitcoin
dollar
is very popular in Latin America, though, right? So Bitcoin, like,
oh,
it's not
absolutely.
just
No,
what El
look,
Salvador, it's many other places.
no. It's growing everywhere, but it's still. I mean, if you kind of look at, I mean, I look at the Malcolm Gladwell thing, the tipping point theory, right? You get to 10% and then something really gets adopted. I mean, if you go look at the curves of cell phones or computers or cars, anything that got adopted, adoption is slow in the beginning. You hit 10% penetration and then boom, it really takes off. And I kind of feel like we're somewhere right around there. I mean, everyone says, well, you're too late on Bitcoin because if you didn't buy it a lot cheaper, you missed the boat. I think when history is written 30 years from now, that view is going to be revised. I still think we're actually quite early. I mean, because the first 5 or 6 years from '09 to 2013, 14, I mean, people didn't even know if it was going to work. I bought some in 2013. I met core developers in MIT. They were like, I'm really concerned about this technology. I'm not sure it's going to be robust enough to do what they think it's going to do. I mean, these were the guys who were working on it, right? So, so we're not, and that was 2013. That was 10 years ago.
Yeah, wasn't it like Gavin Andreessen? Didn't he leave the project? That was trying to remember if that was the right person. I think that was him.
I can't recall his role exactly. There are others who will know that, but the point is that they went through a lot of changes. I mean, they had SegWit, they had the block wars, they've had all kinds of things that have improved it. They've really, I mean, we're now 800,000 blocks in and 15 years of more or less flawless operation. And so finally it's, I mean, you got to the stage where, some of the biggest financial institutions in the world, like BlackRock, said, you know what, this works and we're going to support it. And of course they did that because they see a way to make money off it. And some would argue they did it because they see a way to manipulate it. And there might be some truth in that. I mean, it's gray, but the point is that, things are changing, and I still think we're really at the beginning we're at the cusp of what I consider to be a great awakening to the fact that these governments don't serve our interests anymore. I mean, I saw a fascinating chart that I put on my Twitter feed about a week ago that showed that 80% of the people in the United States do not trust the federal government. Isn't that amazing? I mean, we live in a representative democracy in theory, of course, not in practice. 80% of them. I mean, who are the other 20%? Do they work for the government? I mean,
they're on Twitter. They're on Twitter calling you and me names. Yeah.
Yeah, maybe.
But 10 accounts, burner accounts.
Yeah, but the point is, I think the point is that, I mean, people are coming to be able to see with their own two eyes that this isn't working anymore. This system is really not working for me. This system is really and deeply and sadly broken. And historically, when that has occurred, big changes have taken place. And this is fourth turning kind of theory. You know what I mean? And, I don't know, in America, it was in 1776. I mean, look, Brits, this isn't working for us anymore. We're forming our own country. Or, in 1865, it was like, look, this slavery thing is not acceptable, and we're going to address it. And, and then in World War II, the fascism and so on and so forth, and the hyperinflations that preceded that. So the point is that I think the system is very badly broken. I think the system is going to evolve into a much, much better system. But in the interim, we're going through this rather tumultuous period where a lot of people are getting hurt, and we're all kind of trying to figure out how to navigate it. And to me, at the core of it all, I mean, I see people, blue people yelling at red people yelling at blue people, and I'm kind of like, no, guys, you're not in the right fight. That's not really the issue. The issue is, are we in a sound money system, or are we in just a government printing money system?
Or a
And the
Ponzi
fact is,
system.
exactly, exactly. And
2008,
so,
we were discussing, you were in agreement, I think, before we started recording, that more or less the system post 2008, with all the bailouts and the derivatives and the banking system problems with fractional reserve banking, it went full Ponzi.
that's exactly right. And so we live in a Ponzi based economy with, just unlimited money printing, and nobody really knows what money is anymore.
And bubbles.
And it's and yeah, and so we just go from one financial bubble to the next. And so and it's horribly unfair, and it creates it changes society. I mean, it redistributes wealth. It creates these quintillionaires, the people at the top who are just insanely rich, and it makes the person at the bottom, who has to pay the price of that inflation without their wage going up, that person just suffers horribly. And so that, I mean, to me, and the thing that I think the quintillionaires fail, in the WEF, and all these people fail to recognize, is just how outnumbered they are. And so we're going to slowly but surely see, I believe, a new political ethos emerging that's going to address this. And my view is it can't happen fast enough, because it's a broken system.
More people are waking up. I think more people are not trusting the mainstream media, mainstream financial media. They do pump and dump. They're not bringing up any of the issues with any of these artificial intelligence stocks or NVIDIA, any of the accounting issues. They were calling anyone who's looking into the financial statements Twitter randos or trolls. They weren't looking at any of the arguments there. I mean, the system, though, is so corrupt, and there's so many advantages for JP Morgan. I remember 6 or 7 years ago, there was people saying, take your money out of JP Morgan and the too big to fail banks and put it in a credit union. Well, if any of those banks, Lawrence, get in trouble, I mean, like, the average person doesn't understand. They don't get the easy bailout funds. They get predatory. If they need capital from the Federal Reserve Bank, if you're a regional bank or a credit union, you don't get funds at the terms that JP Morgan does. You might not get funds at all. So the average person doesn't understand any of this. I remember there was a movement to take all your funds out and put it into a credit union.
Yeah, no, that's right. I mean, it's I don't know. Don't get me started on all that. I mean, they broke the law with BTFP. I mean, the law says the Silicon Valley Bank depositor should have taken a haircut. I mean, Dodd-Frank came around post 2000. Remember 2008 and Occupy Wall Street? I mean, everybody was very pissed. I mean, the bailing out the bankers in 2008 was probably one of the greatest crimes of the century. And, I mean, these guys had run the economy and done control fraud to lever the whole thing up, knowing that if it broke, they would get bailed out, and they did. And a year later, they were all wealthy again, as if nothing had ever happened. And yet people all across the country had lost their homes and been an enormous disaster. And so, that was addressed with Dodd-Frank, which said, we're never going to do that again. And then, of course, along comes Silicon Valley Bank, and we did it again, and they bailed out Silicon Valley Bank. And so, and I think as people become aware of this, they become aware of just how corrupt the federal government is, and just how it does not represent or serve their interests, and just how the two parties really don't give you an opportunity to vote for, quote unquote, something else. I mean, Trump arguably a little bit more than, Biden gave you that. And that's what he appealed to when he won, and he ran and he won. He was certainly a better choice than Hillary, but even he, continued the spending and is not perfect. I mean, the only voice I see out there, and he's not perfect either, but I have to say he's a much better choice than the two mainstream candidates, is RFK. I mean, I think a lot of what he says makes sense. He's not of the uniparty, and the uniparty is basically driving this country right off a cliff. And sadly, that may be what it takes for us to finally wake up and start thinking for ourselves, and electing some people that we like and can trust, and that can get all this under control. It's entirely possible to do it. And we see sane actors, like we see this governor of Texas who's, basically taking on Biden and saying, hey, I'm not going to let all these guys come across the border. That's, it violates our sovereignty. I mean, I love it. And there needs to be more of that. And there will be. That's the point. As things get worse here, look, we're a big, intelligent, smart country with a lot of great people. And, we will solve these problems. I mean, I remember the 70s. There were a lot of problems in the 70s, and they got solved. And, these will get solved too. But, there'll be troubles and there'll be ups and downs, no doubt, throughout this process. And I think the core issue is the monetary issue. At least, that's my belief, that really, sound money is the solution to these problems.
Well, people's bills are going. Let's play this out. So, like all this currency debasement, high taxes, the monetary inflation, it's causing people to lose their standard of living. People are becoming more and more desperate, more and more morally bankrupt. This is why you see crime increasing with the carjackings here in DC, the shoplifting that's going crazy, the girls and guys that are doing like sugar mama, sugar baby stuff. For extra cash. So like people are doing this stuff, like this is kind of Weimar Republic, Germany type of moral decay, moral bankruptcy stuff with the internet and apps and stuff like this. Very, very similar.
Yeah, no, it absolutely is. And it's tragic. I mean, one of the other stats that I hate when you look kind of the decay of society. I mean, we're one of the only large developed countries where, the actual average age is decreasing, which means, more and more people are dying. And then I think it was Luke Groman who actually had some good tweets on it, which talked about the crime, the deaths of despair, which are kind of alcoholism, suicide, drug overdoses. I mean, I don't know if you've looked at the chart on that for the United States, but I mean it's just been going straight up. I mean this is kind of Soviet Union sort of stuff before the Soviet
drug
Union
overdoses,
collapsed.
drug overdoses too. I mean, people are depressed. People are playing video games. Adult males are playing video games at record amounts. They're not going and getting jobs. It's probably
I mean,
that's not really for Nick.
Yeah, what percentage of the country are taking SSRIs? I mean, it's high, right? I mean,
well, and opiates, I mean, like tons of drugs.
Yeah, so look, it's a broken system, and all any individual I think can do is look at it, recognize it for what it is, and then adjust their behavior and their investment decisions to account for that, and then support people who believe in sound money and who understand how broken the system is. And that's why, I mean, RFK embraces Bitcoin. He understands what it is, and he understands, I think, that the country is broken, and so therefore, I'm a supporter. But and as I say, he's not perfect at either. I mean, really, no politician by definition is perfect, because to be a politician, you've got to, the certain parts of your character that are just not necessarily altruistic. But there are, in my opinion, there are some who are better than others, and so. I think, and I also think that the times will, people will rise up, and good people, the need will get filled, just as, the leaders emerged in prior crises in these countries, in our country, to solve the problems. I think as the problems here get larger, the correct leaders will emerge, and people will see it, and support them. And I think we've got, enough history and enough high quality people in this country with the right values that we will ultimately pull this thing out of the ditch. But I've been at a lot of things recently. I've been to a lot of different presentations, speeches, etc., and I've seen a lot of things that would suggest to me that this is we're at an important juncture here. I know I've got kids in their 20s, and they can't think about buying a house. They can't afford it. They're doing fine. They're doing average for their age, but they can't afford it. And that's just not right. And they may want to delay having kids because frankly, it's expensive, and that's not right. And, so things need to change. They definitely need to change, but they will, I'm very confident they will.
So I want to transition now to gold and gold stocks for the last part of the interview. We're at a gold price. You're also a gold fund manager. So my listeners are going to be like, you talked about Bitcoin the whole time. You didn't talk about gold. Lawrence is a gold fund manager. Why didn't you ask him questions about gold stocks?
Yeah.
Okay, so
Yeah.
we'll spend the rest of the interview talking about gold stocks. Okay, so we're at
Okay.
a gold price right now at over $2,000 an ounce. I look at the cash flow multiples, the valuations on some of these gold stocks, other than Agnico Eagle, which had a great earnings recently. Some of these
Yeah.
gold miners, the discount to net asset value, some of them are trading at 50% discount to net asset value. Have you ever seen a disconnect or divergence like this before between the gold price and the valuations on the gold stocks?
I really, I really haven't. It's kind of nuts. People say, why is this occurring? And I think it's just because the stock market's doing great, and that's the shiny object that everybody's chasing right now. And yes, some of these things are trading at 70% discounts to net asset value. And I have a portfolio full of companies, many of which have cash flow multiples of 2, 3, 4, 5 times, which anyone who's a financial manager knows, that's a damn good earnings yield and makes these stocks very cheap. People say, why is that? And I answer it very simply. Go to Bloomberg and Google or search for the consensus view on gold prices 5 years out. So one thing we know about gold mining is it costs money to take gold out of the ground. There's something called an all-in sustaining cost. And the ASIC, which is ASIC, and it's measured per ounce, and that's grown steadily at about 10% a year. It went up even more during the pandemic, but average it out for 5 or 6 years is close to 10%. And average ASIC in the industry right now is running 1,200ish, maybe approaching 13 actually, and the gold price is 2,000, just over, sometimes a tad below. So that's a $700 margin, but you got to use that margin to replace what you found and to build the capex and continuing capex to keep your plant running. So that's just your marginal cost of pulling the ounce out of the ground: labor, explosives, electricity. And so what's going on, I think, is that people are saying, okay, so back to my early point, you go to Bloomberg and you say, what's the 5 year out gold price? Well, you know what it is? 1750. So the average analyst, the average financial and commodity analyst in the world is saying that gold is going to be 1750 in 5 years. Well, guess what? If you've got a $1,300 cost to pull it out, growing at 10% a year, you can do the math. You're not going to have you're going to have zero profit in 5 years. So, now I think the 1750 is ridiculous. I mean, I think in 5 years, gold could be at 5,000. I'm highly confident it'll be at 3,000. So even if the costs continue to increase, and they're increasing because there really is inflation, they're going to be very good margins. But this is the way commodity businesses trade. My partner, David Foley, who's really brilliant on this stuff in terms of commodities, and he was involved with a fund prior to this that was involved in the oil business and investing in oil companies. And we all remember when the price of oil was negative because nobody could find a place to store it. I mean, there was a time when the oil patch traded very much like the gold patch. Things were trading at 2 times cash flow because nobody ever thought the price of oil would go up again. And then, of course, we had COVID and everything happened, and boom, price of oil went to 130. And so my point, I guess, is that I think as these monetary problems unfold, gold is going to break through its high of 2,100. It's going to do so with authority, and there's going to be a real shift in the mentality of everybody in the world. And the money is going to come flowing into this area. And I mean, the reason I say this, I mean, you've got probably $40 trillion now in the U.S. stock market. Perhaps it's bigger than that. You got the entire gold stock marketplace is probably 500 billion. I'd have to ask Tavi; he has the number exactly, but it's less than $1 trillion. And so the point is, and why are they all over there? Well, because the Magnificent Seven have been doing well, and the S&P's gone up X% a year, and blah blah blah. I mean, for 40 years they've been trained to buy the S&P dip, and for the last 5 or 10 years, gold's been a rough ride. I mean, it worked well in 16, 17, and 18 were kind of shitty. 2019 was pretty good. I mean, I was up 97%. 2020 was good. I was up 120%. But frankly, the last couple of years, I've gone down 20 or 30% a year. So, it's been a rough ride.
Well,
Right.
also the divergence to what I talked about, there's actually the gold price in other currencies is very high, and there's strong demand for gold, but it's not for gold stocks. So in mainland China, if you're worried about the Chinese stock market, Chinese real estate, currency debasement of the Chinese yuan, you're not buying gold mining stocks. You're buying physical gold. You're paying 10% premiums above spot prices in
Correct.
Shanghai. So you're not buying gold mining stocks.
That's correct. And so, and the stock, and by the way, the stocks have risk. They have beta. The general rule of thumb is, gold up 10%, stocks up 30%. So you get more, but that works in reverse. Gold down 10%, stocks down 30%. So, yeah, and And one of the things that I think is really important, though, is that gold has started to diverge from the real interest rate. And I think the reason that's happened is that people can smell that the print is coming. And so, here's in my view, here's what's going to happen. The stock market is going to top out and roll over. It's either there or very close to being there. As it does so, the bond market in turn is going to start to roll over as well. And interest rates are going to go higher unless the Fed comes in with yield curve control. But it almost doesn't matter what the Fed does. And once the stock market stops performing as well as it's performing, and gold is through 2100 and gold stocks are going up strongly, you're going to see a real rotation. Because one thing investors always do, and we know this, is they chase performance. And so once the performance of the gold stock starts to get to be strong again, and once the S&P looks like it's not doing as well, and the inflation problem has not been licked, and interest rates are going higher, and layoffs are increasing, and the economy is hurting, people are going to realize, you know what? This is the perfect environment for gold to do well, because when inflation, when the economy is hurting, that's the other thing. That's going to lead to burr. Even if inflation is high, I think at the end of the day, government will print even with high inflation, because, the one thing the politicians do not want to do is not get elected. And the two things that lead them to not get elected are high inflation and unemployment. And so when unemployment comes around, and I think it will, I think, this next cycle, we're going to have significant unemployment. They're going to come up with stimulus programs, which are going to be inflationary for sure, but they're going to do it anyway because people are going to be clamoring for it. I mean, remember, the COVID thing was a perfect example of, those stimmy checks. People like that, people like that a lot, and they now know how to do it. And so UBI, stimulus, I mean, Gavin Newsom was talking about California gas prices are too high. Maybe we'll send everybody a check. And
They
this
did
is
that
the way
in
the
Japan.
politicians.
They did that in Japan. I don't know
Right.
how long they did it for, but they did do a
Right.
gasoline subsidy
But
for briefly.
yeah, but this is the point, though. This is the way people in government think. What can we do to stay in office? Okay, we're going to send out bread and circuses. We're going to send out money. It's inflationary for sure.
Subsidy check.
Yeah, we're going to give you a subsidy. Yeah, it's inflationary for sure, but we're going to do it. Why? Because it buys votes. So again, all roads lead to monetary debasement, right? I mean, sadly, I think our kids will, today, I worked at a gas station when I was a teenager. The gas was 26 cents a gallon. Okay. Right. I mean, that's a long way from what we pay today. Right. And what are we paying today? $3-4 a gallon. I mean, I can see very clearly a scenario where when my kids are my age, they're paying, 10x, well, no, it's 10 or more X for their gas. I mean, so what would they be paying $70 a gallon for gas? I mean, maybe by that time, we'll be on some kind of a different standard, gold or Bitcoin or something. But the point is that over longer periods of time, monetary debasement is just so highly probable that to save in anything that doesn't protect you from that is just insane. To bonds are just insane. It's just no point in being there.
Well, I also think that the supply demand dynamics for physical gold for non-G7 central banks, physical gold demand for private sector outside of Western countries, outside the G7, it's very, very strong. Some of the fundamentals are setting up similar to uranium. I know gold's not depleted like uranium is in a nuclear power plant, but the risk reward, the valuations, the uranium miners were in a bear market for a very, very long time. The gold stocks are hated. The earnings for some of them are good. The industry is also dealing with tremendous structural problems with ore grades falling. That means that it's going to be very difficult to keep lowering costs. Cost of capital is higher now. Lawrence, I know you invest in juniors. Are juniors actually able to raise money right now?
Very few, only the best. And, the best juniors are being very smart. They're just husbanding their capital. A junior really, I've got companies that are selling for $10 an ounce in the ground, and they're not spending much money, which is smart. They shouldn't. They should just sit there. The one nice thing about a junior company that has a meaningful gold deposit is that deposit's not going anywhere. Okay. So why go raise a bunch of capital to develop it when the capital's hard to raise and the margins on it won't be high enough to really justify developing it? Do you know what I mean? Why not just quote unquote, almost hibernate, keep your costs low, and sit there and advance the project slowly but surely, waiting for the day when the gold price explodes. And when it does, so in a sense, what these become is call options on higher priced gold. You know, and I mean, like I say, I've got companies selling for $10 an ounce on the ground. When the gold market is healthy, transactions take place at between $100 and $200 an ounce in the ground. Okay, so that's 10 to 20x what these companies are selling for today, right? Now, I'm not suggesting that, we're going to get there overnight, but my point is that these things are just rock bottom cheap because nobody wants them. Nobody thinks you need them. Everyone thinks we're going back into a deflationary environment. Everyone believes that gold price is not going to go up, et cetera, et cetera. And, I'm here to tell you, Jason, hey, every economic thing I look at tells me the gold price is going to be stunningly higher in the next 5 years. I mean, just stunningly. People are going to be shocked, in my opinion.
And there's low cost gold miners and also royalty companies like EMX Royalty.
Oh, absolutely.
They're looking how discounted their valuation is relative to free cash flow, profit margins, those types of things.
Absolutely.
And EMX on the valuation, they just announced a share buyback.
Yeah, I love EMX. It's a great company, very well run, very cheap. I mean, look, yeah, and I'm talking about some of these things that are drill stories that don't have any production yet. I mean, that are just sitting on a nice asset, waiting until they can really develop it. I mean, the other thing that's a lower risk place to be is in a real producer. I mean, these companies, it's not like these companies are losing money; they are making money. I mean, the dividend, I think, last time I checked, I think the Newmont dividend is 4 point something percent. I mean, that's similar to a T-bill. You know what I mean?
B2 Gold, B2 Gold's lower cost, and I think their dividends around 6%, and they're one of the lower cost mid-tier miners.
Exactly. I mean, these companies are making a lot of cash at today's gold price. And, there's operating leverage. Flex that gold price to 2,500 or 3,000. Oh my God, they're going to really make a lot of cash. And I think that's where gold is going. The price of gold is going. I mean, you see it being bought in the East. You see all the central banks buying it. And as monetary debasement becomes more obvious, large institutional investors are going to realize that this is one of the ways to protect themselves. Now, some will realize that Bitcoin's a way as well. But to be frank, I mean, I was just over in Dubai for a week, and the Arab nations. I mean, some of them are going to be buying Bitcoin. Don't get me wrong, but if they really think inflation is going to be a problem, their first go-to monetary, solution is going to be gold. I mean, it's 5,000 years of history, right? And so, look, they're both going to work. Bitcoin's a faster horse, but in terms of a solid protect against monetary debasement, gold will do the job for sure. And gold isn't going to be at 2,100 much longer. Gold is going to be at 3,000, then it's going to be at 5,000, then it's going to be at 10,000. I mean, one of the things I'll state, and then I got to run, and I've said this in many interviews, but it's important to understand it. If you go back and look at the monetary aggregates pre or post, so Bretton Woods is 44, and they set the system, and they say, all right, America, you've got all the gold. We're gonna peg the gold price at $35. And we're gonna go on to kind of a dollar gold standard exchange standard, and of course that blew up in 71. Nixon broke the peg, but in the 60s and 70s, you could kind of do the math, and you could take the U.S. monetary aggregates and you could divide by our 261 million ounces of gold, and you came up with $35. Surprise, right? It kind of worked. If you did that, just to show you how much money has been printed, if you did that same math today, okay, and you said, all right, how much money is there out there, in the world today? Take the standard monetary, and you divide it by the amount of gold that America has. Gold would need to be $80,000 an ounce to support, for the gold America holds to back the dollar, to fully back the dollar. It'd have to be $80,000 an ounce. That's a long way from $22,000 an ounce. Now, I'm not suggesting we're going there, but the reason I think that number is interesting is it just gives you an order of magnitude of how much money has been created and how much gold has been demonetized. I always laugh because the Bitcoin guys say, oh, gold has this enormous monetary premium. No, it doesn't. I mean, the government has done an incredibly good job of demonizing gold, getting no one to focus on it, nobody to care about it, and manipulating the price. I mean, the price of gold is dirt cheap compared to if it were really a monetary substitute, it should be much, much higher, orders of magnitude higher than it is right now. So,
I also think that cost that you said around 1,300, that number is misleading because the averages with 7th or 8th grade math, because included in those averages, you have the super low cost producers with the best mines on the planet, like a Lundin Gold, Fruta del Norte, and Agnico Eagle, which owns the 2 best mines in Canada. Agnico's what, 11 or 1,200 an ounce. Lundin Gold's like way below $1,000 an ounce. Most miners
they're at 800 or 900.
Yeah, most miners do not have a mine like that. Most miners, their costs are 14, 1,500. They're around those.
Correct.
And it's looking higher with labor costs and cost of capital. All these costs, especially if ore grades fall, the costs are not going to drop.
That's exactly right. And so the point is that, I mean, if the price of gold falls back down to 15, 1,600, you're going to see a lot of gold mines close. I mean, there's just a lot that wouldn't be economic at that level. So, I mean, they're making money today, but they're not excessive profits in any way, shape, or form. And so, but what it really comes down to, what the monetary stuff comes down to, is what form of money do you trust? Okay, it's pretty simple. And you can say, well, I trust the American authorities. I trust the dollar. Okay, fine. And frankly, probably that's smart compared to most other currencies, because it is the cleanest dirty shirt, as Brent says. But, in a government the way ours is structured, in the system the way ours is structured, I want to hold the money I want to save. I want to hold it in a denomination that the government can't print, because I got, a couple hundred years of history, and more specifically since 71 and accelerating, that show that the government prints money to solve problems. This is really pretty simple. I mean, we were at an $800 billion Fed balance sheet, pre the financial crisis, the GFC. Then they took it up to 3 trillion plus. Okay. And they brought it down a little bit. That didn't last. And then bang, then the GFC hit. Then we went to 9. Now we brought it down a little bit. I mean, the next one's going to take us to 25. And the Fed balance sheet is a proxy for the money supply, as everybody knows. And so it's really just printing money. And as that money continues to get printed, the price level has to go up. And your savings, the value of your savings, has to go down if you hold it in that form of money. The government can't print gold. The government can't print housing. The government can't print Bitcoin. That's all you need to know. It's
and other commodities. I mean, uranium has had its run. There was a ton of bears for uranium for
absolutely
years.
No, absolutely. Copper, uranium. I mean, it goes against all things. The government can't print corn, can't print oil. I mean, yeah. And of course, if you go back and you look at the 70s, you look at the history of the 70s, you look at the stocks that did well in the 70s, they were all commodity stocks. The 2 best performing categories of stocks in the 1970s, I mean, kind of 35% compound annual rate of returns, were gold stocks and oil stocks. And, Tavi's got some great charts, and actually Ronnie Stofferly from Incrementum does as well, that show kind of the Dow against commodities. I mean, commodities are criminally cheap, and the Dow is criminally overvalued. And, we all know in economics, these things mean revert over time. Now, you can't get the exact timing perfect. And so right now, it doesn't feel so great to be a gold stock investor, but just wait. Just wait. This is coming. I mean, it won't be long now. It won't be long. Hey, Jason, I made a commitment to my wife. I gotta go. I gotta run to dinner. But I've really enjoyed talking to you, and I'm sorry to cut it short. But I think we've been going for about an hour and 20. So
yeah, we were talking for 20 or 30 minutes before I start recording. So I want to thank you so much for your time, and I'll attach a link to your fund's website and also your Twitter.
Okay, sounds great, Jason. Thank you. Take care. See ya. Bye-bye.